Today, technology makes up 35% of the S&P 500, and if the tech sector falters like it did back in the late 90s, early 2000s, it could be crippling to your investment portfolio. In today's video, I'm going to show you what happens if that occurs again and how to protect yourself from the fallout of another tech bubble bursting. Let's jump in. With the recent run-up of the technology sector, in particular the Magnificent Seven, we've just had incredibly outsized returns from this group of companies. In fact, 2023, these were the bellwether companies of the market. Apple up 48.9%, Microsoft having a huge year, all seven of them combined for phenomenal returns. Meanwhile, the S&P 500 is up 26%. So bottom line, the tech sector had a phenomenal run in 2023, and that's continued into 2024, although signs are showing that there could be cracks in the tech sector. And now that it represents 35% of the S&P, what happens if we get another bubble bursting just like we did back in 2000 through 2002? This video is going to unpack strategies you can use to protect yourself from another bubble burst. As a result of the tech sector being the top performer over the last 5 years, the S&P 500 has been the big winner relative to other asset classes. It's heads and tails above the rest. Many people that I know have loaded plenty of their money into stocks like Amazon, Nvidia, Microsoft. And there's an old adage that says we want to buy low and sell high. And yet I'm watching people chase and they're buying at the top, which can be a recipe for disaster. In order to take a look at the way to protect yourself from a tech crash, we need to explore what happened the last time this took place in our markets. So I'm going to bring you back to 1999, where the S&P had just finished a 10-year run of being a phenomenal performer. And in that year, it was up 21%. Heading into the following year, 2000, the market was down. 2001, it was down. 2002, it was down. It had a 3-year unweighting where literally the tech sector was falling apart and we had a 3-year bear market. We then had 4 years of recovery and then headed in and had the 2008 financial crisis. So the last time the tech sector broke, it broke in a big way, leading to 14-year returns on the S&P 500 of 4.68%, or less than half of its long-term average of 10% per year. And if this was the case, and you had all of your money in the S&P 500 back in 1999, and you were taking about 5% out per year, you had to go back to work in 2016 because you ran out of money in your portfolio. So the way to protect yourself against that is to make sure that you own a diversified portfolio with lots of different asset classes. So this is the decade from 2000 to 2009. S&P 500 lost 1% per year for an entire decade, literally decimating people's retirement planning. But meanwhile, small companies in the US more than doubled. You had value companies in the US that had a positive number. You had real estate that almost doubled in the same decade. But then you had the emerging markets that quadrupled. You had international small cap that more than doubled. And so you can see that owning a diversified mix of securities, heck, even bonds, you didn't quite double the money, but you did fantastic. You at least were in positive territory. And so this right here highlights the best way to protect yourself if the dot-com bubble bursts again, just like it did back in 2000. The reality is no one can know for sure. No one can predict the future. And if anybody is claiming that they can, you should run, don't walk from them, because it's simply not true. The data is overwhelmingly conclusive. The markets move too fast, and there's no information that's out there that people are somehow using to get ahead of market movements. So the best protection, the best defense that you can use in your investment portfolio is to build a globally diversified portfolio full of all the asset classes that you're looking at on the screen right here, and do it in such a way where you don't own enough of any one thing to make a killing from it or to get killed by it. So your US large companies, particularly the S&P 500, which now has 35% of its holdings in technology, that really shouldn't make up any more than half of your overall portfolio, maybe something like 35 to 50% at most. Throughout the rest of the portfolio, you're going to want to have US small companies, international large companies, international small, emerging markets, REITs or real estate investment trusts, and of course bonds or fixed income. So if you approach your portfolio construction in that manner, you're going to protect yourself from whatever may be coming to the tech sector right around the corner. And for those of you out there who are saying you only want to invest in the US and you don't want to invest internationally, let me expand your minds a little bit. This is data going back to 1970, so it's over 50 years of data, and it's showing that yes, the S&P 500 has been a very good investment in that time period, and we're not knocking that, but a globally diversified strategy has been the clear winner over long periods of time. And in fact, you can see that the danger in putting all of your money in any one sector or any one asset class, the S&P 500 included, is that it can go on long losing streaks for many years. And the 2000 to 2010 period, that's not the first time that had happened. From 1966 to 1982, the S&P 500 underperformed cash, bonds, and inflation. Also, 1929 to 1941, the S&P 500 underperformed and didn't make any money in a very long time period. So again, you want to build a globally diversified portfolio, and you want to rebalance throughout market cycles, sell the things that are up high, just trim them and bring them back into alignment, and buy the things that are lower so that you can maintain your discipline and not be caught off guard if the tech sector bursts again. I hope you found this helpful. I know portfolio construction can be complicated and quite nuanced. If you need help with this, please feel free to get in touch with me. I'm happy to help you. Also, make sure to like and subscribe to the channel and share this with anybody who you think it could benefit, and we'll see you on the next one.